Chris Urso here with Urso Capital Partners, back for our 11th consecutive quarterly update here. Going to go through our Q3 quarterly portfolio update, and also we're adding in and trying to improve here. We're going to do a whole section kind of on the market and some of the key driving forces that we're seeing out there, share our thoughts on it, and we actually are adding in a special guest here that's going to be joining us now on these quarterlies moving forward to share his perspective. We have Chris Gorman, our Managing Director of Investments at Urso Capital Partners, here with us.
Hey guys, name's Chris Gorman. I've been with Chris and URS for about 7 years now. I oversee the day-to-day operations of the firm with a heavy focus on investments, development, asset management, and investor relations. So really excited to be here. I think we have a good presentation for everybody, and excited to jump into it.
Awesome. So as I touched on, we're trying to improve this. This is obviously a little bit better than my little circle face and my screen share, but we've got a lot to cover here. So we're going to actually put this into a 2-part series for everyone. So the first part will be market, and second part's going to be the portfolio. So for those of you that are new and this is your first time watching one of these, a little bit of background on Urso Capital Partners. My wife and I started the firm back in 2008, started buying distressed residential properties throughout northern Kentucky and Cincinnati, basically residential 1 to 4 family foreclosures. We did that for about a year and a half, and then we really kind of kicked off the concept of what Urso Capital Partners is today. And we pivoted and began focusing on multifamily apartments. We bought our first vacant 40-unit apartment building in December of 2009. And since then, we've gone on to acquire over 5,000 apartments. We've added development to our platform back in 2019. Since then, we've now gone on to develop nearly 1,300 apartments. We've done about 34 transactions to date. We've since sold 23 of those. We've realized about a 32% IRR and a little bit over a 2.07 equity multiple. We currently have over $250 million of investor equity. And since inception, we've been fortunate enough to be able to raise over $375 million of investor equity. One thing I do want to highlight is that we built our business really buying heavy value add, reposition 60s, 70s, 80s vintage properties. We saw things start to adjust in 2019. We began selling pretty aggressively. Since 2019, we went on to sell 13 assets worth over $350 million plus of sale value. And we really took a beat, and that we did that between 2019 to 2023. Kind of took a beat, didn't buy anything in 23, really focused on getting our house in order, playing defense where we needed to play defense, making some strategic investments in both people and technology to prepare to begin to grow again as the next cycle started to materialize. Since the beginning of 2024, we've gone on to acquire 8 properties. We have another two assets under contract. We believe that this is a great environment to be buying into. There's definitely a lot of dislocation out there that we're going to touch on as well. We'll talk about that a little bit further on. So we've been fortunate enough to raise over $100 million of equity in one of the most challenging environments that I've seen in my career to date. And I think that's a testament to the relationships that we've built with our equity partners. We're very, very grateful. We built our business on private capital and focusing on deep, long-term relationships. And we want to continue to acquire in this environment. We're looking at buying good deals at an attractive basis in markets that we want to be in for the mid to long term. So I want to also take a second here and touch on our in-house management team, because without them, we wouldn't be able to do what we're doing day in and day out. URS Properties is our dedicated in-house property management division. I just want to wish, a heartfelt thank you to our exceptional team of 40 plus individuals throughout the Southeast across 7 states that are day in and day out, going above and beyond to service our residents, implement our business plans in a very challenging environment, to be quite candid. And we're extremely grateful for those team members that we have. We're now in our third year of having property management in-house. We've got some exciting announcements that we're going to share as well on that front. But the teams that we have in place, they go above and beyond, not just for us, our residents, and most importantly, our investors as well, on a daily basis. And one of the toughest operating environments that, again, we've seen. All right, so for those of you that may not be familiar with us, I'm going to just touch briefly on Urs Capital Partners, a little bit of our background and how we got here today. So I started the company with my wife, Lisa Urso, back in 2008, coming, right prior to the GFC. So really kind of had to figure things out very quickly. We started focusing on buying distressed residential 1 to 4 family rental properties really throughout kind of northern Kentucky and Cincinnati. We did that for about a year, and then we started to shift our focus to small multifamily apartments. We bought our first vacant 40-unit building in December of 2009. Since then, we've gone on to acquire over 5,000 units. We added development to our platform back in 2019. We're now up to about 1,300 apartments that we've built ground up across 5 projects. We've sold 23 deals since inception. And we've been fortunate enough to, we've raised nearly $375 million of private capital since the beginning of 2008. And, we've built our business relationship focused. Many of our investors are still with us from our first 40-unit building. I'd say well more than 50 to 75% of our investors are in multiple deals with us. And that's allowed us to kind of transact when some other groups may have had some challenges, specifically in the last 2 years. So prior to the beginning of 2024, I'm going to kind of look back to 2019. We began to start to see prices run, cap rates begin to compress prior to COVID, and we began to start harvesting gains on some of the older assets in our portfolio that we built our business on, more of the 60s, 70s vintage. We continued to sell through 2019. We bought 3 deals through COVID, and then we saw the market start to run wild, and we began selling pretty aggressively between 2021, 22, and 23. From 2019 to 2023, we sold over 13 deals, totaling over $360 million of value across those assets. We didn't buy anything in 23. We kind of took a beat. We made some investments in infrastructure, in people, all in preparation to be able to capitalize and begin acquiring as the next cycle began to reset. And looking back to the beginning of 24, we've acquired 8 assets since January of 2024. We have another 2 deals under contract. We've been able to raise over $100 million of capital since January of 2024 to do those deals. And we're really focused on, 3 main drivers. It's, do we want to own this asset for 10 years? Do we want to be in this market for 10 years? And are we capitalized appropriately to own it for 10 years? And we're really looking to acquire good assets at an attractive basis in really strong locations that we're familiar with. The average vintage of our portfolio today is probably 2010s and newer, where for, from 2008 to 2022, it was probably, mid 70s vintage. So we were able to sell those assets at a premium, start to trade up in quality. And now the best combination in real estate, in my view. One of our longstanding investors told me this a long time ago: any chance you get to buy quality at a discount, take it. And that's what we're seeing today, the ability to buy, better quality assets, at a yield that is commensurate with what 70s and 80s vintage assets were trading at just 4 or 5 years ago. So we think this is an attractive time to be buying from a basis perspective, and we're excited to keep pressing forward. So we have a lot to cover here. This is going to be a long one. I think we're going to break it into a 2-part series. But I want to touch briefly on our property management side as well, because these are the people that really keep the machine moving. We took property management in-house the end of 2022. So we're now about 3 years into having property management internal. We don't do any external management, no third-party management. It's strictly a platform designed to drive execution of our business plans in Urs Capital Partners. It allows us to have total control. I want to recognize the amazing team of 40 plus dedicated, professionals that we have throughout the Southeast, from our regional managers down to our site teams, our maintenance teams, our grounds teams. We wouldn't be able to do it without them. It's been a pretty challenging environment for the last 3 years in multifamily. So those of you that aren't in the space, I tell this to a lot of our investors that are not really in tune the way that we are day in and day out. Our industry has been in a pretty significant recession since kind of the second half of 2022. We're starting to see little glimpses of light and little spots here and there, but having control of our management through this process has really proven out to be such a tremendous asset and resource for us versus some of the other owners that leverage third-party management, maybe only have one or two assets with a third-party management company. There's nothing free out there anymore in our business today. There's no free rent growth. There's no free occupancy. You have to earn it day in and day out, and we're very, very grateful to our teams that show up every single day and fight the fight on, to deliver a great product and experience to our residents, but also to, perform on behalf of Burst Capital Partners and our investors. So very grateful for that.
All right, so I wanted to jump in and touch on the markets that we currently have a presence in. So our portfolio today spans 5 states: North Carolina, South Carolina, Tennessee, Georgia, and Maine. We're very intentional about where we invest, focusing on markets with strong population, job growth, diverse employer bases, overall pro-business environment, and true barriers to entry. A great example of a target market for us is Rutherford County, Tennessee, just outside of Nashville. It captures all the economic momentum of being roughly, 25, 30 miles from downtown Nashville, access to the region's core industries like healthcare, entertainment, manufacturing, automotive, combined with, just massive ongoing investments in infrastructure improvements, right? In Tennessee and Nashville, you have the $2 billion Nissan Stadium redevelopment, Oracle's 8,500, job tech campus, right? So a lot of improvement. And then when you look at Rutherford County, it really has its own economic backbone, right? The $7 billion Nissan manufacturing plant, employing 8,000 people, NHC Healthcare, Middle Tennessee State University, among so much more. It's been the number one fastest growing county in Tennessee for 8 straight years, with population up more than 10% in just the last 5 years, which is just, pretty phenomenal growth. That's the kind of market profile we like: high growth, diversified, and sustainable. Beyond Tennessee, we continue to build on our presence in Charleston, Savannah, and Charlotte, and Wilmington, which all share similar fundamentals: strong immigration, business-friendly climates, and solid long-term rent growth trajectories. We've also been very focused on re-entering the Atlanta market. We're being selective, targeting specific submarkets with the right demographic and income profiles. I've made multiple trips down recently, and we've been in best and final on a few opportunities. As the liquidity returns to the market, Atlanta tends to be one of the first major metros to benefit, simply because of its scale. It really is a bear of a market. So it's a key focus area for us heading into 2026. We're always open to opportunities outside of these core markets. Select markets in the Midwest remain on our radar. But right now, these Southeast markets remain our primary focus and where we continue to see the best, long-term fundamentals.
So I want to touch a little bit on kind of year-to-date occupancy. So this is some of the new things that we're adding in that I didn't really touch on in some of the prior quarterlies, really more of a macro view. And this was a good graphic. I pulled this one out just because I thought it would be, beneficial. It kind of highlights, across the way, like, occupancy quarter over quarter. Yes, I'm at that point. I'm 47 and now I need readers. Quarter over quarter. You're seeing occupancy from 95.7% in Q1 to 95.4% in Q3. Again, I share this and do these updates because, I get the email sent to me from the articles that get printed in the journal or the sound bites that are on the news for 30 seconds that are typically very backwards looking and also somewhat of clickbait. It's important to understand the underlying fundamentals are still extremely healthy in our space. Not to say that we're not subject to macro moves and macro, effects from a, economy perspective. We are, but the demand has remained fairly healthy through this year. I want to say where, as you could see through Q3, 637 apartments were absorbed. We've seen occupancy maintain about 95%. And this is an interesting one because it shows you through the different areas in the country how rent growth is performing. We've been seeing flat to negative rent growth, for the last 2 years. One of our investors just shared a CPI print that came out for shelter, and it showed rents kind of dropping, 8-9%. And it was so overstated because when you looked back for the last, 8 quarters, it showed positive rent growth, which didn't exist from a practical level. And we've showed you guys quarter over quarter actual operating data, and we're going to continue to do that for you. But I just want to share some of the macro things so you can see that, we are in a very resilient industry sector, right? I know it sounds simple, but everyone will always need a place to live. We're coming out of two significant events, 50-year high in supply that will likely never see that amount of inventory be delivered inside of a, 3-year window again in our career. The last time that happened was over 50 years ago. And we're coming off of 500% increases in interest rates. And then tack onto that an inflationary environment, insurance costs in some markets doubling or tripling. So there's a lot of things that came together in a very short period of time. However, it's a very durable space to be because it provides housing, right? At the end of the day, I know that seems so simple, but that's why the macro numbers are still where they are. And you're seeing occupancy rates 95%. You're not seeing them at 88%. You look at office when times were really bad. Look at retail when times were really bad. Look at hotels when times were really bad. Look at industrial when times were really bad. You're seeing occupancy rates in some instances 70s, 80s, very low, maybe low 90s. But in the worst of worst times, when you look back over 50, 60 years, you're going to see multifamily occupancy rates on a national level. I think the worst it got was post GFC. It was around 90%. So just important to shed some light on that.
All right, so now I'm going to take a couple of minutes to talk about, supply and demand, both nationally and within our markets. So, both supply and demand in the multifamily sector remain well above long-term averages. What's interesting is that while both are starting to slow, the pace of that slowdown is very different, as supply is decelerating, much faster than demand. Q3 saw the lowest construction starts out of any quarter in the last decade. Construction starts today equate to delivery in the next, call it 24, 26, 28 months, depending on the size of the deal, right? So in the next 2 years, one could deduct that there will be less completions than there has been in 10 years based on the amount of starts. RealPage does a phenomenal job with all the data. So much of what I'm about to say is right from RealPage, but approximately 474,000 units were completed. I believe, 474,000 units were completed in the trailing 12 months ending Q3 2025. That marks the third straight quarter of declining deliveries since the peak. This is all nationally. The peak was Q4 2024 when completions were north of 575,000 units. So that's about a 19% decline, almost nearly 20% decline in new supply over the past year. In Q3 2025, we saw the lowest quarterly completions in the last 12 months in just one quarter of about 105,000 new units. So again, further evidence that starts and completions are both decelerating at a fairly fast pace. Now, one thing we watch closely across our markets is when that wave of new supply peaks. Typically, a 200 to 300 unit lease up takes around 24 months to be fully absorbed. During that period, operators are going to be very aggressive, offering multi-month concessions, rent discounts, whatever they can just to get buildings stabilized, especially in today, which is a very challenging operating environment. That pressure creates short-term softness in the market. So we generally expect rent growth to flatten or in some cases even go negative, then start to turn positive about 2 years, 2.5 years after the peak in new deliveries. So this chart, which we'll show on the screen here from RealPage, is really interesting and highlights that we are well past the point of peak supply as it relates to construction completions. For example, sticking with the Nashville trend from earlier, peak deliveries in Nashville occurred Q4 2023, which suggests that those units should be fully absorbed by Q4 2025, right? 2 years later. Once that happens, supply and demand should come back closer to balance, and we'd expect rent growth to normalize and turn positive, maybe in the middle of 2026, towards the end of 2026. Charlotte, on the other hand, hit its supply peak roughly a year later, implying it could take a bit longer for rent growth there to rebound. Of course, other factors do come into play: population growth, employment, income levels, etc. But this looks at supply and demand in a silo. At Earth, we're of course looking at the broader MSA level data, but we really drill in on the submarket's supply level as well. Even in markets facing supply pressure, there can still be pockets of opportunity. Submarkets with limited new construction within, say, a 5 or 10 mile radius. Real estate really is a local game, and that's where we're concentrating our efforts and where we get extremely granular when looking at new opportunities. So we're in the thick of it right now, hopefully near the end of that heavy absorption phase. As a result, we have seen effective asking rents dip in some of our markets. And nationally, asking rents are down about 0.3%, which makes sense in this environment. Most operators, including us, are prioritizing resident retention and high occupancy over squeezing out every last dollar in rent. That strategy has paid off, and our portfolio occupancy closed the quarter above 95%, which puts us in a really strong position heading into the next cycle of rent growth and heading into 2026.
I'm going to touch on capital markets very briefly, just to give you an idea of interest rate trends. We put this chart together for you. Just shows you, kind of the 5, 7, and 10 year. That's basically what our fixed rate financing is pegged off of. A lot of our investors, most of our investors understand that, but a lot of people that aren't invested in our space think that, because the Fed says it's cutting interest rates, that interest rates are going down. Fed's cutting short-term interest rates. So you can see the 30-day SOFR has been coming down very slightly from, 432 in Q1 to 418 as of the close of Q3. But what's most interesting to us is the 5, 7, and 10 year. We've seen consistent moves down, with the 5 year the biggest mover, down 32 basis points. The 7 years down 22 basis points. The 10 years down about 15 basis points. That's what we borrow off of when we do fixed rate financing. So, for example, we bought Palms at Edgewater in April. That was a 5-year fixed rate loan at a spread of just under, I think we ended up closing out the spread at about 97 basis points. We were able to fix out our debt on that right around 4.8 in the 480s, I believe, 4.86, give or take, for 5 years fixed rate, full term interest only. So we're seeing positive leverage on the deals that we're buying again. And what that means is we're able to borrow in the high 4s to very low 5s, but we're looking at buying deals that are stabilized or stabilizing to 5.5 or 5.75, with the goal to get them to a 6 inside of the first 24 months and then build incrementally from there. Important to note on our current portfolio, our stabilized assets. So you're going to see throughout the presentation, we've broken out all of our KPIs into 3 baskets: stabilized, which are assets we've had for more than 1 year; recently acquired, or assets we've had for less than 1 year; and then we put our developments and lease-ups in their own basket as well. So for our existing assets that we've had that we fall in the stabilized bucket, our average loan to cost is 63%. So we've never been a big leverage firm. We're always willing to sacrifice a little bit of return on paper to have that safety, because one thing we've seen, we're watching groups, we're seeing the deals come in the door of groups that leaned into leverage in 21 and 22, and they've gotten blown up, or they're not, they're doing capital calls, they can't refinance their bridge loans. So the only thing that can screw up a really good piece of real estate is being over-levered. If you have staying power, time heals all wounds in this business, and that's why we've always been a little more modest than most on the leverage side. So our recently acquired deals have come in at about just shy of 61%. So if you average those out, we're about 62.5% on loan to cost. Our developments and lease-ups were even more conservative. We don't do any big preferred equity or mezzanine lending or anything like that. We take on very low leverage bank debt for a minimum of an initial 3-year term, if not 4. We don't do short term, like 2-year money or 12-month money. So we really keep our leverage modest, but we're seeing really good opportunities in the capital markets. There's a plethora of liquidity on both the agency side and the private credit side. We're seeing spreads come in. Maybe one of the things we can add in the next quarter's update is where we're seeing spreads across each one of these products for agencies, life companies, and debt funds, to give you some perspective on that. So agency spreads are probably, at par somewhere between 125 and 140, depending on the product, the term. And then you have options where you're going to get discounts on that spread if you choose. Bridge financing from the debt funds is probably ranging in the neighborhood of, we've seen, and we're doing one right now. This is actually through a bank, but it's a 185 spread over SOFR. Which is very aggressive, but we're seeing the debt funds, on larger loans of good, for good properties, they're in the neighborhood of, call it, upper 180s to probably 225 spreads over SOFR. I don't ever pretend to be an interest rate guru. I'm not by any means, but it does feel like, we're in an environment where with what we're doing today is kind of at the peak of the current rate cycle. I say that cautiously, but that's the way it feels. We actually, we saw a rate cut recently. I think there's another meeting coming up here in the next day or two, and we'll see what happens from the Fed side.
Okay. Sourcing activity, one of my favorite topics. Excited to jump back in here. So quarter over quarter, deal origination is up just under 20%. Honestly, when you look at the total volume and engagement we've had, it feels like more than that, right? What the chart doesn't fully capture is how much more actionable these deals have become and how much our pipeline has truly opened up towards the end of Q3, really starting in September through today. The bid-ask spread is tightening, and we're finally starting to see sellers come back to the table, whether that be by their own admission or forced by a lender or a preferred equity investor. Of the 9 deals that we've submitted on in Q3, we are under contract on 2, which we'll expand on later in the update. And we were in best and final on 6 of the remaining 7. So in those cases, we stayed disciplined on our pricing. We didn't stretch beyond where we're comfortable transacting. And the key takeaway is that these weren't just placeholder offers to stay active in a certain market. These were 9 real, fully vetted opportunities where our intent was to win the deal. We're very pleased with the 2 we locked up this quarter, and we're continuing to track the others very closely. As we've seen time and time again, including with our Palms at Edgewater acquisition in Q2 of 25, deals often come back around, especially in this environment, which is why we remain disciplined on pricing. We offer at our number, set the terms that we can stand behind, and when those transactions fall apart and sellers need certainty of close, we're ready and able to step in. So we put the effort up front and continuously track deals we're going after. And that has shown to be a very successful strategy time and time again in challenging environments. And, we've bought a number of deals that way where, our first offer wasn't accepted. We follow up, we stay on the broker, weekly check-ins, weekly calls, and 1, 2, sometimes 6, sometimes even 12 months later, you get the call back, hey, the deal never closed, the buyer dropped, they couldn't raise the money, whatever the case may be, and sellers need an exit. We get the call and we're ready to step in. So look, the pipeline is very healthy. I expect in Q4 we'll continue to bring in even more opportunities, and it'll be interesting to track. We brought in 47 in Q3. We'll see if that number goes north of 50 come year end. Okay, ERS activity per market. This chart highlights the MSAs where we're most focused right now. So Charleston continues to be one of our key expansion markets. We reviewed 11 deals there this quarter, which really shows the depth of opportunities we're seeing and our commitment to growing our footprint in the Charleston MSA, especially considering it's a smaller market compared to some of these others, less inventory, less transaction volume than some of the larger markets we're focused on. Atlanta, as seen here, it's another market we're putting a lot of energy into. We've been making a concerted effort to reestablish our presence, spending time on the ground, touring assets, narrowing in on a select group of submarkets with strong demographic fundamentals. As liquidity returns, Atlanta is a market we want to be well positioned in, given its scale and long-term growth trajectory. So I expect more to come on Atlanta in 2026.
This is another pretty cool thing that we're looking at and tracking closely, and we started doing this earlier this year, is really drilling down onto the transaction volume quarter over quarter. So specifically within our markets, and this one's a little tough. There's a lot going on for those of you that are looking at it as well. So just give me a sec. I got to zoom this in so I could see a little bit better. There we go. So what was interesting here for me in Q3 is that transaction volume was up nearly 80% quarter over quarter. So if you look at, there were 60 total transactions in the markets that we're covering, totaling just under $3 billion, $2.7 billion. In Q2, there was 47 transactions at $1.6 billion. So we're seeing the bulk of that. Charlotte doubled in sales volume, went from 6 to 12. Charleston went from 2 to 9. Atlanta has been very consistent and, in line with historical numbers in terms of typically has the greatest velocity of deal flow because it's the largest market in the Southeast. But this is really good for us. It kind of gives us a pulse on where the market is, how capital is flowing. And I think the next chart is even, more challenging to read, but hopefully you're able to see this because this is one of the more interesting things for me is that the sales volume is not all distributed equally. 2020 and newer vintage product is kind of leading the charge with 20 transactions of those 60. And again, this is just within our markets. This is not on a national level, only in the markets that we either have existing assets or that we're targeting to acquire in. 1970s was second, which was somewhat surprising with 13 transactions. However, when you look at 2000 and newer vintage, that makes up nearly 40 of the 60 transactions that were done in Q3 amongst our markets. I want to point out also that we track kind of the average pricing across each one of these vintages, right? So if you look at 1970 vintage, the average price per unit across the 13 deals that were sold was $128,000 a unit, plus or minus. The 1980s vintage assets, there was only two of them, one in Atlanta and one in Charleston, averaged $150,000 a unit. 1990 vintage, there was four of those, $162,000 a unit. And then you start to creep into the 2000 to 2010 vintage was $199,000 a unit. 2010 and newer, $216,000. 2020 and newer, nearly $240,000 a unit. For us, like this is the stuff that we love to look at because it just is showing us where capital is flowing and how different assets are being viewed, right? So there's clearly a lot of liquidity for 2000s and newer product, especially on the equity side. On the older vintage assets, the 70s and 80s, not quite as much, because what we're not seeing here is the amount of deals that are in that universe that were acquired in 21 and 22. So out of these 60 deals, it looks like a meaningful jump in transaction volume, which it was for sure. However, it's not necessarily an indication that, everything's great and money's flowing. We get into the office between on and off market deals a week, just for via email, phone call, or text, anywhere from 5 to 10 deals a week that are coming in across our markets that, 9 out of 10 are just quick no's, don't even look at because they're too small, too big, too old, too new, outside of the realm of markets that we want to be in. But you'll see, as Chris referenced earlier, he showed you kind of our filters then from this deal flow, the deals that were brought into our office that we spend the time in and then go through. There's opportunity to be had in each one of these segments that we're going to touch on a little bit later. But, we built our business on the 70s type product and we're following the 70s, 80s, 90s stuff closely, but we haven't seen enough of a meaningful discount for that to be worth the risk. we're seeing better buying opportunities for us in the 2000s, 90s, 2000s, and newer product where, when times are good, that stuff's trading probably inside, call it from a return profile. If we can pencil to a 14 to a 16 on a 2015 or 2020 newer product IRR without any aggressive assumptions, that deal 5 years ago would pencil to a 9 to 11 IRR at the pricing levels that they were at. So that's the dislocation that we're seeing and we're excited about, the risk-adjusted return profile, where we wouldn't have historically had access to a lot of these profile deals, that because there's a lot of uncertainty out there around interest rates, around rent growth, around, macro headwinds that are out there floating around and headlines, there's a lot of institutional capital that's still sitting on the sidelines, a lot of private equity, private capital that's still sitting on the sidelines, waiting for things to get better and waiting for signals to move. And to me, we want to be accumulating while that uncertainty exists, quality assets, again, that could produce a really healthy risk-adjusted return that, should a couple of things move in our favor, we have the ability to create those outsized returns while protecting our downside in the near term.